Hello and welcome. If you're considering selling your mortgage note but unsure where to start, you're in the right place. Selling a mortgage note can unlock significant cash, simplify your financial life, and help you achieve your financial goals. Today we'll walk you through the process step by step, ensuring you get the best value in a smooth transaction. And why sell your note? So you've decided it's time to sell your mortgage note, whether you need cash for a new venture, want to streamline your finances, or prefer a lump sum payment over monthly installments. Selling your note can be a smart financial move. This guide will help you navigate the complexities, avoid common pitfalls, and maximize your returns. Understanding your mortgage note. Before we dive into the steps, let's clarify what we mean by note or mortgage. These financial terms refer to various financial obligations, like promissory notes, deeds of trust, or contracts for deed, are typically created outside traditional financial institutions. Your note is your personal property and can be sold at any time. Some people refer to this non-traditional financing as seller financing or private financing. Size of the private financing in the United States. The private financing market in the United States is substantial, with an estimated $123 billion in outstanding debt attributed to owner-financed transactions. On average, approximately $22.5 billion in new owner-financed paper is created annually. Residential properties account for 52% of these transactions, followed by commercial properties at 25% and land transactions at 15%, with the remainder categorized under other. Typically, residential buyers apply a down payment of 25% of the purchase price twice towards their purchases. Commercial buyers average a 34% down payment, and land purchasers come in at 32%, illustrating a varied landscape of down payment practices. Interestingly, 85% of these transactions originate from individuals creating one or fewer notes per year, highlighting the prevalence of individual participation in this market segment. This robust market offers ample opportunities for those looking to sell their mortgage notes to capitalize on their investments. Types of note sales. When selling your mortgage note, you have options tailored to your financial needs. You can choose to sell 100% of the note or opt for a partial sale, where you retain a portion of the payment stream. Full sales. These are the most common type of note sales, involving the sale of all remaining payments due. Partial sales. This option allows you to sell only a specific portion of the note's income stream, often commanding a higher price compared to full purchases. There are different types of partial sales, which will be covered in a separate video. These options provide flexibility depending on your immediate financial needs and long-term goals, ensuring you maximize the value of your mortgage note sale. Reasons to sell your note. There are several compelling reasons to sell your mortgage note. 1. Hassle-free ownership. Some people want to avoid the stress of managing monthly payments and uncertainties about borrower reliability. 2. Immediate cash needs. Some individuals have unexpected bills, medical expenses, or major purchases. A lump sum payment can provide financial relief quickly. 3. Estate planning. Many families concerned with estate planning opt to sell their note to simplify their inheritances, ensuring a cleaner legacy for their loved ones. 4. Lack of servicing expertise. Some people originated a note later figure out they do not have the expertise to service their note, as they are not in the mortgage business. They do not feel comfortable managing the complexities of servicing a note. 5. Risk management. Owning a note involves legal risks and uncertainties, from borrower defaults to potential lawsuits, and some people feel the risk and unknowns are too high. 6. Borrower challenges. When borrowers face financial difficulties or default, selling the note can mitigate risks and financial losses. Steps to sell your note. Now let's outline the practical steps to sell your mortgage note smoothly and maximize its value. Step 1. Gather documentation. When gathering documentation related to your mortgage, the more information you have gathered and have readily available, the more professional you will appear to your note buyer. The more accurate your financial information, the more reliable your quote or contract will be, and your note buyer will not have to call you back and reprice your mortgage toward the true or accurate information. You will need to collect all essential documents related to your note. Promissory note. This document describes the payment obligations of the borrower, the exact interest rate, monthly payment, and terms of the repayment will be gathered from this document and will be presented to your note buyer. Deed of trust or mortgage. This document details the collateral, borrower obligations, and the maturity of the mortgage. Settlement statement. This document outlines the fees, costs, and down payment when the loan was originated, property insurance and tax records, You must ensure that the borrower has paid all property taxes and there is a current insurance policy in place on the collateral. This will also ensure that your loan is fully performing on all obligations under the deed of trust. Borrower credit report. Understanding the borrower's creditworthiness is essential to understanding how the note's value can be substantially changed by the borrower's reliability. The borrower credit score relates directly to the reliability of the payment stream, ability to refinance, and risk in the borrower. Generally, in order to get the highest price for your mortgage, your borrower needs to have a score of 650 or greater. Step 2. Gather payment history and transaction reports. You will need to have detailed payment histories to demonstrate borrower reliability and note performance over time. You will need to know the principal balance and how reliably the borrower has paid their debt. Step 3. Collateral details. You will need to be able to properly describe the property collateral thoroughly, including its legal description, market value, and any appraisals or evaluations. Step 4. Request quotes. Once your financial documents are gathered and known, you can contact a reputable note buyer to request quotes, which will ensure transparency and clarity regarding closing costs and transaction timelines. Step 5. Agree on a price. Review your offer carefully and select the best type of sale that fits your needs. Thereafter, sign a purchase contract that outlines terms, including adjustments for received payments during the transaction process. Be sure to understand what fees the seller and buyer are responsible for. Consult your personal attorney to review the contract if you do not feel comfortable reviewing these documents yourself. The simplest way to explain price is the closer your mortgage resembles a traditional bank's mortgage, the higher the price and vice versa. Step 6. Closing process. Gathering your documentation ahead of time will help facilitate a smooth and quick closing process. Your note buyer will go through the following step to get your sale closed and your funds in your pocket. 1. Request documentation. Most of the documents gathered in steps 1 and 2 will need to be submitted to your note buyer once the contract is signed. 2. Verification. Your note buyer will confirm all document accuracy compared to quote contract and validity. This step is where your preparation yields big dividends. 3. Appraisal. An appraisal will be ordered to assess the current market value of the collateral. 4. Title insurance. A lender's title policy will be ordered to address any title issues that might be outstanding. 5. Closing documentation. After all steps are completed, your purchase documentation will be finalized and sent out for signing. 6. Funding. Once you have signed, closing packages received back reviewed. Your proceeds from the sale will be sent to you. Congratulations on a successful note sale. General misconceptions. It's important to address common misconceptions that sellers may encounter when considering the sale of their mortgage note. Here are a few key points to keep in mind. For real estate collateral value. While the real estate securing the loan impacts the note's value, it's crucial to understand that you're selling a stream of income, not the property itself. The note's value is determined by the reliability and duration of this income stream. Any increase in the real estate value primarily benefits the borrower unless in a collection scenario, totaling all future payments. Some sellers mistakenly equate the total future interest payments with the loan's value. However, since the borrower can pay off the loan early, the income stream isn't guaranteed. However, since borrowers can pay off the loan early, the income stream isn't guaranteed. Sellers typically receive a percentage of the principal balance, with the percentage received reflecting the risk involved. Loans structured similarly to traditional bank loans, which are more predictable, command higher prices, typically 95% to 98% of their principal balance. Seller finance notes typically sell between 90% to 70% of their principal balance, which depends on a large number of factors. Understanding these misconceptions helps sellers navigate the sale process more effectively, ensuring they make informed decisions based on the true value of their mortgage notes. Selling your mortgage note doesn't have to be complicated. By preparing thoroughly and working with reputable professionals, you can streamline this process and achieve a fair price for your note. Thank you for watching. If you're ready to explore selling your mortgage note, reach out to us for a free consultation. We're here to help you navigate every step of the way.